Hi everyone, Sean Humphreys here. Welcome to the presentation, Can You Actually Time the Market? Learn the Facts. This is a part of a series of presentations we've developed to look at various important investment principles that we need to be mindful of when we're investing our hard-earned capital. These principles, if acted on a consistent basis, will really increase the probability that you'll hit your long-term performance return expectations on your account. So let's get into the presentation right now. The slides and the busy information on this particular image is designed to really illustrate the point that there's a wash of information. We're just overwhelmed by the sheer data of information when it comes to investing. So whether you look at cable networks, you look at CNN, BNN, CNBC, CBC, blog posts, newsletters, there's no end of pundits out there that purport to know how to look into the future and forecast what's going to happen in the world. But the reality is there are people who have been able to forecast maybe once accurately, very few people any more than that, and often these guesses are more luck than they are in-depth, robust scientific analysis and prognostication ability. So how is it that we can actually make good, sound, consistent investment decisions in this avalanche of information we have to deal with? And I'd submit that much of this information is really for entertainment purposes in many ways. Some pundits have referred to it as financial pornography. It's there to get our attention. It's there to get our eyeballs, because ultimately the purveyors of this information get advertising revenue by getting our attention. And of course, our attention is garnered because of fear and anxiety and concerns about the capital markets and the economy, not about the good things that are going to happen potentially. So we tend to see information that's skewed in areas that actually lead to unproductive investment decisions. So one of the very real issues when it comes to investing is this desire to get bull market returns, good returns, without going through the pain of bear markets. But the reality is, to get bull market returns, we have to often go through bear markets. They're part of the same equation. And I won't get into that particular topic in a lot of detail. That's a separate presentation. But what I want to do is look at this issue of timing the market. Can you actually get good market returns without going through the sting of a bear market? Is that possible? Now, you might know people that purport that they've been able to do that over time, but I want to look at one particular study that is very interesting and kind of sheds some important light on this particular area. So the chart that you're looking at looks at investment returns. It's for a 10-year period ending in 2010, and each of these bars on this chart illustrate performance numbers over that 10-year period. And when you think about it, if you look at 2010 and go back the previous 10 years, there's a lot of volatility during that period. That incorporated the financial banking crisis in 2008, and there were many other market upheavals over that time frame. Now, as we go through this presentation, it's really important to keep in mind that this presentation is relevant for those of you that have investments tied to the stock market, either directly in stocks or stock mutual funds or investments linked to the stock market. If you're an investor who can reach your objectives buying guaranteed investment certificates, term deposits, government guaranteed bonds, then this presentation is not relevant. You can be out of capital markets and reach your goals. But that's not the majority. The majority of people have some percentage of their portfolio in the stock market, either directly or indirectly, and that's what this presentation is geared towards. So the far left column says 6.6%. And what that represents is you handling your portfolio in such a way that in the 10 years preceding 2010, you took your portfolio, stuffed the investment certificates in a safety deposit box, and literally didn't do anything with the portfolio for 10 years. And at that end of that 10 years, reinvesting all your dividends and leaving the portfolio alone, it grew to 6.6% compound annualized return performance. A lot like my stepdad, who at the time I was working for Royal Trust, and he said, Sean, I've got these investments, and we had what was called an investment administration service. And he said, I want to know what these investments are worth. And so we had all these stock certificates of very high quality companies. They had gone through stock splits and dividend reinvestment. And I think his cost base was something like $60,000. He ended up having around $600,000 in portfolio value. And it was over a number of years. But literally, it was 100% stocks, had done very well. And he had just put the money in the safety deposit box and then left it alone. So this first chart is almost like that. You ignore the markets, you let the portfolio do its thing, and at 10 years, about 2,500 trading days with 6.6% compound annualized returns. The next bar is positive but very minor. The return was 0.3% compound annualized returns. And in that bar, we took out the 10 best trading days over that 10-year period ending 2010. It's extraordinary. It's actually quite shocking to see that 10 days really drove the overwhelming majority of performance in the Toronto Stock Exchange Index over that time frame. And so here's my point. The reality is if you and I are trying to get bull market returns and avoid the sting of a bear market, one of the strategies will be to leave the market or reduce our equity weightings when we think there's market volatility or trouble. But it would be very easy to miss the momentum in the market using that strategy. If you and I exit the market, pull our money out of the market and go to cash, what's the chance that we will put that money back into the market as the market begins to improve? And I would submit that it would take an awful lot of really good information for you to put the money back into the portfolio. And in fact, that's the case for most people. We need a lot of corroborating evidence to give us the confidence that now is the time to go back into the market. So if you leave the market, chances are you're going to miss the initial momentum. And many times the market surprises on the upside. To sort of at the point of maximum pessimism, we often see the market improving. You look at some of the historical upbeats in the market, and particularly over this 10-year period, if you look at the newspaper reporting and the media reporting over that time period, you would not have guessed that there'd be a major market move. So the markets tend to surprise on the upside. The chances of timing when those 10 best days would be over that 10-year period would be almost impossible to predict. So I would submit that if you're going to pull the money out, you're probably going to miss that market momentum. If you look at the 20 best days, which is the third column, your returns now are minus 3.6% on a compound annualized basis. And at the 30 best days taken out was 6.6% on the negative side. The minus the 40 best days, we're talking minus 9.2% per year. You've completely imploded performance. So what this chart illustrates is that I'm not saying that there shouldn't be fine-tuning in a portfolio, there shouldn't be adjusting your asset mix, likely taking profits and moving money to a more conservative area if you need income, sector reallocation, pruning portfolios internally by portfolio managers. I think fine-tuning absolutely makes sense, but actually making a major market call like, are we in the market, are we out of the market, is not a productive strategy. Often I think clients think that I'm being a little bit simplistic when I say that time is the investor's best friend. But this chart clearly illustrates that time is in fact the investor's best friend. So if you want to have the bull market returns or the returns that you're aspiring to on the stock portion of your portfolio, whether it's individual stocks that are high quality or managed portfolios like mutual funds or other managed accounts, then you need to be mindful of this and be very wary when someone's recommending to you that you should pull all your money out of the market. Because from a probability standpoint, that's not likely to be a very productive strategy for you. I hope you found that particular strategy helpful. For those of you who are at a point where you're beginning to think about retirement income planning, or you are retired and you want to know whether you're on track, we've developed a process called Game Plan, and we'd be more than happy to connect with you if you want to have that updated, if you've already gone through that process with us, or you'd like to explore it. We'd be happy to set up a phone call, have a conversation about the process, let you know how it works. And it's really designed to help to give people real clarity about whether they're on track for the retirement income goals, to make sure they don't have more life than income, that they have an investment strategy that is customized and tailored to their retirement income goals. And so we'd be happy to review that with you. We have information on our website about the game plan process. You can get more information, helpful videos at www.seanhumphreys.com. You can reach our office directly at 204-977-8022. All the best in your investment planning goals. And like I said, I hope you found this presentation helpful. All the best in your financial and investment wealth planning goals.